Last week, we had the very important names reporting like Netflix, United Airlines. And then this current week, we have even more interesting names such as Intel here, Tesla, a lot of tech, Google, IBM. So if you trade the options around earning or interested in earnings season in general, let's take a look at what's important to keep in mind. And so in this video, we will take a look at the upcoming releases and analyze their volatility and what looks mispriced versus well priced. And then we'll dive into the highlights of the week, Intel, Tesla. So stay tuned and let's get into it. Jump in and look at the upcoming week. As we noticed, it's getting more and more exciting as we approach earnings season, where the big names will be releasing early on August. Here we notice that for the upcoming week, obviously the big name that stands out, Intel, with a very high implied move for Thursday after close. Also notice Tesla clearly to be watched. Here we look at the implied move, so how much the market is pricing. Keep in mind, this is the way of understanding the amplitude of move that the market expects from these upcoming earnings. This is a non-directional value, so it's plus or minus, and it's by default basically taken from the pricing of the straddle, so a call and a put at the money. Now here, as we see these numbers, so Tesla and Intel, especially Intel with the highest implied move, another piece of data that's very interesting to keep in mind is basically, let's now put this implied move in perspective with the average historic move. So here we're looking at the past 10 years and doing the average, again, absolute value, plus or minus, of the actual move that happened. So this graph really basically compares the implied volatility to the historic volatility, and here we express it in terms of stock move. So as you would expect, a lot of names are close to this middle line, this diagonal line that shows basically these names are well priced. The implied move is actually well in the range of what happened in the past. And so surprisingly enough, Intel, that seemed overvalued and with the highest implied move, actually, if we compare it to what happened in the past, to the average past move, we see that it is quite well priced, basically 9% on each case. And the same for a lot of the tech names. So we see Google here, Texas Instrument also very well priced, the average very near the implied move. All right, so now that we did this sort of preliminary analysis, let's actually go ahead and look at Intel and see what's behind this somewhat implied move, the highest of the upcoming week. And so right away, something that jumps to mind is that we see how the actual implied move of 9% that we were looking at is actually quite lower than what used to be the implied moves in the last earnings. And another interesting trend is we see how in the last three earnings, the moves were somewhat calm, were way under what was priced in. So for a 14% implied of last October, the move was only a 9%, implied of 12, the actual was only 3, and then same for last one, 10% versus 12. And so here it's important to notice that this actual current implied move of even lower than 9, it's an 8.2. It's quite important to notice how it is aligned with the past average, as we have seen in the graph and as we see here in this breakdown table. But there is a substantial drop in the implied move value from the last one, so from nearly 12%. And this is somewhat understandable because, as we've seen, basically the last moves were somewhat low, and so the market adapted its expectation to this lower value, and so we only get in this 8.2 since for a while now, for most of last year, the implied move was around 12, but the actual volatility did not really make that value. And this is a good example of how the market adapts its pricing, basically. And by analyzing this and noting these patterns, this is where the edge can come from. Now, the other interesting aspect is, as we see here in this graph that shows the actual moves that happened, so in blue, versus the implied moves that were priced in. And so a very interesting pattern is we notice in these two peaks that happened in the last year, not only the big move was, the actual move was quite big, but actually the expected one was also quite enormous. So this is a good indication that perhaps when you notice a very high implied move, some very unusual unusually high, and here unusual even compared to not only the previous ones, but also to the average value in general. This somewhat can be an indication that there is a big expectation, and this does not mean that that value of the implied is necessarily inflated or overvalued. As you can see, even for a 28 implied move, the actual move was closer to 30, 29.7. So it seems that Intel is perhaps not preparing, or the market does not seem to expect a bigger or very important news. And then here, basically, we want to compare two simple metrics. In the past, when the actual move did actually beat the implied, by what was the amplitude of that beat? And we want to know what was the amplitude in average. So if we look at all past releases, when the actual move, the realized volatility was higher than the implied volatility, by how much was it on average? And same symmetrically, if it didn't beat the implied, if the actual was actually lower than the implied move, by how much was that value? If we want to play long volatility, and so betting on an outsized move, we want candidates where the amplitude when there is a beat is usually higher than the amplitude when the stock misses. And we see that this is not the case for Intel. Basically, when it beats, it only beats it by 1.9%. However, when it misses it by 3.3. So these are not the numbers we want for long volatility. This is basically what we would want for short volatility, where we want to sell the premium going into earnings, betting that implied is overvalued, because even the worst case scenario, when the realized volatility actually beats the implied, it does not beat it by so much. So our loss is somewhat controlled and limited. Now, as we're doing this deep dive, let's actually look at another stock that's quite a highlight of next week, quite expected, obviously Tesla. And let's compare these same patterns that we were looking at for Intel and see how they play out for Tesla. Right away, we see in the table that, as you notice in the visual code, where the rows where the realized volatility, the actual volatility was higher than the implied, are noted in blue. And so as the move is higher than the implied, you'll see darker and darker blue. And right away, it jumps to our eyes that, okay, Tesla is usually a big beater, as you would say. The actual volatility tends to be quite higher than the implied volatility. And so perhaps this is the type of setup that's more favorable for long volatility. And now let's compare that those other stats that we looked at for Intel of, okay, when it's beat by how much and when it doesn't by how much. And we see that for Tesla, the statistics are more appealing, more a good signal for this long volatility, where we would bet that the realized is higher than the implied. This is somewhat confirmed as we look in the past this past graph, where we see a lot of the blue lines highly exceeding the purple lines of the implied move. And then notably, the most important thing is that we see, contrary to Intel, when there's a beat, the average value by which the realized volatility, the stock moves higher than the implied, is 5.3. When it misses it, it only misses it on average by 2%. So we see here how it's quite different from Intel, that is not a huge beater. Tesla, it seems, if it beats it by a lot. When it doesn't, it misses it, but by not so much. And so this is the type of signals we want for long volatility. And so right away, let's go to the simulator to actually simulate what a classic long volatility position would behave. Here, obviously, we're thinking of the closest expiration straddle, so a call and a put at the money. We're recording this, so the last stock price for Tesla was 328, composing the straddle of 327.5 call and put for the July 25th expiration. Right away, let's scroll down to see, so we know our break even. That's we know that this is the implied move that we were looking at on the calendar. But then we can also evaluate our likelihood of success. This is really basically comparing this break even to the past moves. And so as you can see, when we plot the break even on top of the histogram of past move. A histogram is really a graph that shows the distribution of the past moves, so the value of the move versus the count, how many times it occurred. We see that our break even is quite tight basically where a lot of moves happened outside that break even. So this is again a good signal for us. And then especially what we like in these long volatility plays is the risk reward. And to get a realistic idea of the risk reward when it comes to earnings, we really want this benchmark of what happened in the past. And so as you can see in this section, we're basically using the values of average and standard deviation to try to summarize that distribution of past moves. We see that a realistic minimum move, a realistic low move, and here we use the approximation that a low move, a minimum move would be the average minus standard deviation, same as a maximum move that would be the average plus standard deviation. And so these two moves constitute basically our worst case scenario and our best case scenario if there's a big move off or if it's disappointing. Again, these come from the analysis that we did on the moves, and we can go even further, select, for example, just the last 2 years or last 5 years and dive more into these statistics. Overall, what we like is that, okay, if the worst case scenario, so a small move basically ends up happening, we're looking at a PNL of 37% in one direction, 29 in the other. See how it's symmetrical because we're non-directional for these positions. However, if a big move happens, so a big move again, statistically speaking, so here we see this average plus standard deviation gives basically a 16% value of a realistic maximum move, where our PNL is around the 100%, 112 for one side, 122 for the other. And this basically gives us an approximation of our risk reward that here you see is basically a 1, 2, 3. We risk 30% overall for a potential win of 110%, 120%. So a 3 to 1 basically. And this is confirmed by our computed risk reward score that here is 85%. But keep in mind, these plays, if we especially play the closest expiration straddle, we are exposed to a big value of loss again. So here notice it's commanded 30%, 40%. A quick way to reduce these sort of maximum loss scenarios, but keeping the risk reward ratio, because this is what we want. We want a reward that will outperform the loss. Let's actually go ahead and using classic strategies here, let's just select the same straddle, but for 2 weeks later or even the monthly expiration. And so here we see basically our break even now is a bit higher. Sure, we can allow basically that exposure, but on the other side, our risk reward stayed, as we said, that ratio of 1 to 3, but the lowest or the worst case scenario loss is now lowered, as you can see, only 16% in one side versus and 21% on the other. Voila, I hope this was helpful. Make sure to tune in next week to see the review of these trades and our analysis, and do the same for the upcoming weeks. If you like what we do and we showed, make sure to subscribe and like the video, and see you in the next video.